Imagine 4 people standing at the starting line of a race. All 4 want to grow their money. All 4 want financial freedom. And all 4 are investing in the stock market. But they choose completely different paths. The first person chooses index funds. The second chooses mutual funds. The third chooses ETFs. And the fourth chooses hedge funds. 10 years later, their results look very different. The surprising part? Most beginners have no idea what separates these investment options. Many people hear these terms every day. Index funds, mutual funds, ETFs, hedge funds. They sound complicated. They sound intimidating. And because of that, many people avoid investing altogether. But once you understand the differences, the financial world suddenly becomes much easier to navigate. Let's start with a simple question. What happens when you don't want to buy individual stocks? Maybe you don't want to spend hours researching companies. Maybe you don't know which stock will perform best. Or maybe you simply want diversification. That's where funds come in. A fund is like a basket. Instead of buying one company, you buy a basket containing many companies. Imagine walking into a grocery store. Instead of buying a single apple, you purchase an entire fruit basket. If one fruit goes bad, the basket still has plenty of value. Investing works in a similar way. Funds help reduce risk by spreading your money across many investments. But not all baskets are built the same. Some baskets are managed by professionals who actively choose investments. Others simply follow an index. Some can be traded throughout the day. Others cannot. And some are designed for everyday investors, while others are built for the ultra-wealthy. Understanding these differences can save you thousands of dollars over time. Because investing isn't only about returns, it's also about costs, fees, risk, and strategy. Before choosing where to put your money, you need to understand what you're actually buying. So let's begin with the simplest option, the investment choice that has quietly created wealth for millions of ordinary investors around the world. The index fund. An index fund has one simple mission. It doesn't try to beat the market. It tries to become the market. Imagine the S&P 500. This index tracks 500 of the largest companies in the United States. Companies like Apple, Microsoft, Amazon, Nvidia, and hundreds more. Instead of hiring expensive managers to pick winners and losers, an index fund simply buys all the companies in the index. That's it. No guessing. No predictions. No complicated strategy. The fund automatically mirrors the market. Because of this simplicity, index funds are usually very inexpensive. The fees are often tiny compared to other investment products. And over long periods of time, many actively managed funds fail to outperform these low-cost index funds. That's one reason legendary investor Warren Buffett has repeatedly praised index investing for ordinary investors. The biggest advantage is simplicity. You don't need to predict the next big company. You don't need to monitor the market every day. You simply invest consistently and allow time to do the heavy lifting. Of course, index funds aren't perfect. When the market falls, your investment falls too. There is no manager trying to protect you from every downturn. You are accepting market performance, both good and bad. But for many long-term investors, that's exactly the point. Instead of trying to outsmart the market, they participate in its growth. And historically, that strategy has worked surprisingly well. Now let's move to the older cousin of the index fund, the mutual fund. Mutual funds have been popular for decades. Unlike index funds, most mutual funds are actively managed. That means a team of professionals decides which investments to buy and sell. Their goal is simple: beat the market. If they believe one company will outperform another, they adjust the portfolio accordingly. In theory, this sounds attractive. Who wouldn't want experts working to generate higher returns? But there's a catch. Expert management costs money. And those costs appear in the form of fees. Even a small fee difference can become enormous over time. For example, a 1% annual fee may not sound significant today, but over 20 or 30 years, it can reduce your final investment value by tens of thousands of dollars. Some mutual funds outperform the market, many do not, and predicting which managers will succeed is extremely difficult. Another difference is how mutual funds trade. Unlike stocks, Mutual funds are usually priced once per day, after the market closes. You can't buy and sell them throughout the trading day. For long-term investors, that may not matter, but it is a major distinction. Mutual funds offer professional management. Index funds offer simplicity and lower costs. So where do ETFs fit into the picture? That's where things get interesting. ETF stands for Exchange Traded Fund. Think of an ETF as a hybrid. It combines features from both stocks and funds. Like an index fund, many ETFs track an index. Like a stock, ETFs trade throughout the day on stock exchanges. This flexibility has made ETFs incredibly popular. If you want to buy an ETF at 10 in the morning, you can. If you want to sell it at 2 in the afternoon, you can. The price changes throughout the day based on market activity. Many ETFs also have very low fees. Some track broad markets. Others focus on specific industries, countries, or investment themes. Technology ETFs, healthcare ETFs, dividend ETFs, international ETFs. The variety is enormous. For many investors, ETFs offer the best combination of diversification, flexibility, and affordability. That's why ETF assets have grown dramatically over the past decade. But now we arrive at the most mysterious investment category: hedge funds. And this is where things become very different. Hedge funds are not designed for most investors. In fact, many hedge funds are only available to wealthy individuals and large institutions. Unlike index funds, mutual funds, and ETFs, hedge funds often use complex strategies. They may buy stocks, sell stocks short, use leverage, trade currencies, invest in private companies, or pursue highly specialized opportunities. The goal is often to generate returns regardless of whether markets rise or fall. But complexity comes at a price. Hedge funds typically charge much higher fees than other investment products. And while some hedge funds produce impressive results, others fail to justify their costs. The average investor often hears about famous hedge fund managers making billions of dollars. But those stories represent only a small part of the industry. So which option is best? The answer depends on your goals. If you want simplicity and low costs, index funds are often hard to beat. If you want professional management, mutual funds may appeal to you. If you want flexibility and diversification, ETFs are extremely popular. And if you're a wealthy investor seeking advanced strategies, hedge funds may become an option. But for most people, successful investing isn't about finding the most complicated investment. It's about staying consistent, investing regularly, keeping costs low, and giving your money time to grow. Because in the end, the most powerful force in investing isn't complexity, it's consistency. And that's a lesson every investor should remember.